Have you ever wondered why the vast majority of professional investors and fund managers consistently underperform the overall market? Despite their extensive resources, research teams, and decades of experience, around 80% of them fail to outperform simple index funds year after year. The reason is simple: they overcomplicate things. They get caught up in trying to outguess the market, make overly complex trades, and outsmart everyone else. But as countless studies have shown, this active trading approach is extremely difficult to execute successfully over the long run. In this video, I'm going to reveal a shockingly simple investing strategy that has been proven to beat around 80% of professional investors and fund managers. It's based on decades of empirical evidence and used by some of the most successful investors in the world. Best of all, it's something anyone can implement without needing a finance degree or a team of analysts. The strategy explained. The investing strategy I'm talking about is called index fund investing. An index fund is a type of mutual fund or exchange-traded fund, ETF, that tracks a specific market index like the S&P 500. Instead of trying to beat the market, index funds simply aim to replicate its performance as closely as possible. By holding every stock in an index like the S&P 500, you'll match the market's returns year after year. And as data shows, the S&P 500 has historically outperformed around 80% of actively managed mutual funds over long periods of time. The main reasons index funds tend to beat most professionals are: 1. Lower costs. Index funds have extremely low expense ratios compared to actively managed funds, which can eat into returns over time. 2. No underperformance drag. Actively managed funds inevitably have some underperforming years, which drags down long-term returns. Index funds simply match the market. 3. Lower trading costs. Active funds have higher trading costs from constantly buying and selling. Index funds are essentially passive and have minimal turnover. 4. No management risk. Even the best fund managers eventually leave or retire. Index funds aren't dependent on any individual. The strategy is beautifully simple: buy a low-cost index fund that tracks the total stock market, and then hold it forever. You'll be instantly diversified, low-cost, and assured of capturing the market's returns minus tiny fees. Some of the world's most successful investors like Warren Buffett, John Bogle, and Charles Ellis have all endorsed this evidence-based approach. Buffett has even instructed the money left to his wife to be invested in index funds after he's gone. Historical performance. Still not convinced? Let's look at the cold, hard numbers over long periods of time. Between 1975–2022, the S&P 500 returned around 10.5% per year on average. Over that same 47-year period, only about 20% of actively managed U.S. stock funds were able to beat the S&P 500 after fees. Even in the short run, index funds tend to beat their active counterparts. For example, in 2022, one of the worst years for stocks in over a decade, around 92% of U.S. large-cap funds underperformed the S&P 500. Need more evidence? The longest bull market in U.S. history was from 2009–2020. However, despite an 11-year raging bull market with steadily rising stock prices, a whopping 88% of active U.S. stock fund managers failed to beat their benchmarks over that period. No matter which timeframe you look at, the results are similar. The majority of professionals underperform simple index investing after costs. This isn't an opinion. It's a mathematical fact backed by decades of empirical data. How to get started? Getting started with index fund investing is easier than you might think. Here are the basic steps. 1. Open a brokerage account. You'll need to open an account with a broker like Vanguard, Fidelity, or Charles Schwab that offers low-cost index funds. 2. Decide on an index for broad U.S. stock market exposure. The S&P 500 and total U.S. stock market indexes are great options. You can also add international exposure. 3. Pick a fund. Once you settle on an index, find the lowest cost index fund that tracks it. Stick to funds with expense ratios under 0.10%. 4. Set up automatic investments to remove the temptation of trying to time the market. Set up automatic recurring investments on a schedule that works for you. 5. Hold for the long-term. Index investing only works when you have a multi-decade time horizon. The longer you hold, the more likely you'll experience average market returns over time. That's it. No complex trading strategies, stock picking, or market timing required. Just buy an ultra-low-cost index fund, invest consistently over time, and you'll likely outperform 80% of professionals. Conclusion. I hope this has opened your eyes to the power of index fund investing. It's the ultimate get-rich-slowly approach endorsed by the world's most reputable investors. No more worrying about underperforming fund managers, deflating fees, or stomach-churning volatility. With a lazy portfolio of low-cost index funds, you can match the overall market's returns while tuning out all the noise and distractions. It's truly an investing strategy that puts the odds overwhelmingly in your favor. So ditch the complicated strategies and embrace the pure simplicity of indexing.